All right, today we're digging into Laureate Education's second quarter earnings for 2025. Now, this report, it was a weird one. It sent some seriously mixed signals, and the market, well, it seemed pretty confused. So let's jump right into the numbers and figure out what's really going on. Okay, so first things first, how did Laureate actually do compared to what Wall Street was expecting? The initial report was a total head-scratcher. You had some really clear wins, but they were sitting right next to a pretty big miss.
And here's the core of the issue, right here. You can see it plain as day. They beat expectations on revenue. They beat on adjusted earnings. But then they miss on the official reported number. So that's the big question we need to answer. What is the real story behind Laureate's quarter?
So let's start with the good stuff. Revenue, over $524 million. I mean, that's not just a beat. It absolutely crushed the high end of what analysts were looking for. That tells you demand is strong. And then there's the adjusted earnings per share. This is the number that a lot of analysts focus on because it shows the core profitability of the business. And again, a really solid beat at 79 cents. So far, so good, right? Well, here's where it gets weird. The official GAAP earnings, the number that follows all the accounting rules, came in at just 65 cents. A miss. So you gotta ask, how on earth does a company beat on revenue and core profits, but still miss on the bottom line? Let's unpack that. Let's just put this all on one page to see the whole picture. You've got the strong beat on revenue. You've got adjusted EBITDA up a very healthy 15% from last year. You've got that nice beat on adjusted EPS. But then, bam, that miss on GAAP EPS just sticks out like a sore thumb. This is exactly what investors were looking at on earnings day. To really get what's happening, you have to listen to what management said on their earnings call. They basically came out and said, look, the underlying business is great. And then they explained all the, let's call it good noise, that was messing with the official numbers. And when you look under the hood, the business looks fantastic. Total enrollment is up 6%. New student growth is even better, up 7%. And check this out, organic revenue, which strips out currency effects, grew by an incredible 10%. And on top of all that, their profit margins got way bigger. I mean, these are all signs of a really, really healthy company. So where did all that confusing noise come from? Well, management pointed to something pretty simple: shifts in the academic calendar. As you can see, revenue is basically just getting moved around between quarters. Yeah, Q2 got a little bit of a boost, but the big takeaway here is that this is just a timing thing. It all evens out by the end of the year. And this right here is the smoking gun for that GAAP EPS miss. It was a non-cash foreign exchange loss. Now, the key words there are non-cash. This is purely an accounting rule. It's not real money leaving the company, it's not a problem with the business, and it has absolutely nothing to do with how many students are signing up. It is the definition of accounting noise. And if you want to know how management really feels about the business, look no further. They raised their guidance for the entire year, for both revenue and adjusted EBITDA. And they said it was mostly because currency trends are looking good. You simply do not raise your forecast if you think you just had a bad quarter. Okay, so the business itself is strong, but the headlines were confusing. So how did the stock market react to all this? This is where we get to the heart of it all, separating the real signal from all that distracting noise. The stock basically did nothing. It closed down just 1% on the day of the report. Now, for a company that just reported big beats, a headline miss, and a guidance raise, that kind of flat reaction tells you one thing: the market was scratching its head, totally unable to figure out what was important and what was just a distraction. And this brings us right to the main question for anyone looking at this stock today. The company beat estimates. They raised their forecast for the year. So why did the market just kind of shrug? Our whole thesis boils down to this: signal versus noise. We think the market is getting completely bogged down in the noise, that non-cash accounting loss and those confusing calendar shifts. And because of that, it seems to be missing the incredibly loud and clear signal. Enrollment growth is powerful, organic revenue growth is in the double digits, and management is confident enough to raise their guidance for the full year. So, with our theses laid out, let's look to the future. If we're right and the market is getting this story wrong, what could happen that might make it change its mind? Here's what we are watching heading into the next quarter. There are really 4 big things to keep an eye on. 1, how do the Q3 results look compared to the new guidance, which already has some of those timing shifts baked in? 2, do those key foreign currencies stay strong? 3,
How well do their 2 new campuses, which are opening in September, perform? And finally, are they going to use that remaining $27 million to buy back their own stock? These are the things that could really move the needle.
So here's our call. We believe that as the year goes on, the market is going to start to see past all this short-term accounting stuff. The focus is inevitably going to shift back to what really matters, those incredibly strong fundamentals like student enrollment and durable, long-term growth.
Look, our view on this is pretty simple. The real story here is much, much stronger than the market is giving it credit for right now. And because it seems like the market is mispricing the company based on all that noise instead of the signal, our rating on Laureate Education is outperform.
Ultimately, the real question is whether other investors will be able to look through this short-term accounting fog to see the clear operational strength that's sitting right underneath. And as always, remember this analysis is just for informational purposes. This is not financial advice.